Recording now. All right, welcome everyone in our follow-up presentation. This is our second presentation by the Masters in Financial Engineering students at Lehigh University. This presentation is going to be more of a structuring presentation, focusing on the structuring of a transaction. A little bit of data involved, but this is mostly about modeling, about having to work with IRS documents, with the SEC. So it's another aspect of the program which I always find interesting. We have with us our sponsor, John Ingleson, in his comfortable backyard. So why don't we, Remus, why don't we start with you, and then Stephen, you share your screen accordingly.
No problem. All right, Stephen, whenever you're ready.
No, I could not share the screen right now. The host disabled it.
All right, you got it.
So, hello today. We're presenting one of the projects of the Lehigh MFE, which is a tax-driven investment fund project. My name is Ramos. I'm a rising senior undergrad student, and I'll be joining the program in August 2021.
Hi, my name is Kaibuki, and I'm graduating this year.
Hi, my name is Aman. I'm a recently graduated undergrad.
Hi, my name is Johnson, and I'm graduating this year.
Hi, my name is Stephen, and I'm the MFE program.
Okay, next page, please. So this is an ongoing project and also a capstone for the current MFE students. The project was launched in fall 2019 and will hopefully be complete in fall 2020. And the topic of the project, like I said before, is structuring tax-driven investment fund. So here we have the timeline of the project. First to do is the investment fund. We have to understand what we're applying and also the registration process, which will be discussed in details of how it works and what are the requirements for exemption of the registration. Secondly, we also find the benefit and the cost of this fund, whether or not it's profitable for investors. After the initial research, we can jump into the marketing and solicitation aspect to attract more investors and people who are interested. After outsourcing clients and companies, we hope to complete this project with an attractive amount of tax deduction. So to tackle this project, I mentioned of understanding the nature of what we're doing. We found that under the SEC rule, this project should be seen as an investment fund, which concludes stocks, partnership, interest, also notes and bonds, and so on. Under the Security Acts of 1933, we know that all offers and sales need to be registered with the SEC, or we need to have an exemption of this registration. To register with the SEC, we have 3 different paths to do so. To register as an investment company under the Act of 1940, with the exclusion of private funds and mortgage-related pools. We could also register as an advisors or brokers to start off. Later, my team will present more the details of the registration process and rules regarding to with the IRS and so on.
Since registration with SEC might be costly and time-consuming, we want to consider using exemptions from the registration. And there are some commonly used exemptions. Next page, please. First of all, it's Rule 506B and C. One of the essential differences between the two is in Rule 506B, the investors can be accredited investors and up to 35 non-accredited investors. Whereas Rule 506C requires all the investors to be accredited investors. Rule 506C is more strict on investors but it permits general solicitation, which is not permitted in Rule 506B. Next page, thank you. There are some other exemptions available, Rule 504 and Rule 147. These exemptions does not apply to investment companies. If the investment vehicle is registered as investment company, then these exemptions cannot be used. In Rule 504, issuer can offer and sell up to $5 million of securities in 12-month period. And in Rule 147, issuer must limit offers to in-state residents of the state where its business primarily is. Under these exemptions, the issuer still needs to comply with state security laws and regulations. Next page, thank you. In order for marketing and solicitation, there are 3 ways to do it. The issuer can employ a broker or can register as a broker or can use exemptions from broker registration. There's a rule in Act that provides safe harbor from broker registration, but the exemption does not allow more than 1 offering every year, and it does not allow compensation for marketing. That's pretty much everything in SEC regulations. I'll pass on to Jonathan.
Hold on, can we just to be clear, I mean, the team is basically acting as an advisor, to the fund, and what we're saying here is that we want to be able to decide what is the best way to position the fund, right, towards potential investors. You know, it's gonna be a large fund, it's gonna be a private fund, and this is what the idea about the marketing and the solicitation.
Right, and actually, we have to either register as an advisor, or we can use some exemptions from advisor registration. Yeah, because we as advisors still need to comply with these regulations.
Correct.
Yeah. Okay, I'll pass on to Jonathan.
So here's the IRS form filing and the tax law and detailed tax benefit. There will be 4 parts. Part 1 is the eligibility rules to create this fund. And the second one is the IRS filing example, which I will show the IRS form that we are using. The third one is a detailed tax benefit. And the last one is the period in effect for the tax benefit. So first is the IRS requirements on forming this fund. Actually, the requirements are pretty simple. The first one is the fund should be an investment vehicle organized as a corporation or partnership for the purpose of investing in qualified property. The second one is a corporation or partnership which creating this fund, they need to file the specific form annually to report that the fund meets the 90% investment standard, and non-compliance can result in significant penalties. This 90% investment standard is determined by the average of percentage of qualified property held in the fund as measured the time on the last day of the first 6 months period of the tax year of the fund, and plus the last day of the tax year of the fund. So the second part, this is the IRS form that we are using, and as I mentioned before, we'll be using this form to self-certify as a qualified fund to enjoy the tax benefit, which means that the fund managers needs to file and submit this form to IRS every year. And since we are still working on this project, it's not going for public yet, I blacked some parts in this form that may contain sensitive information. So here we can see these are the first 2 pages of this form. We can see there are like 4 parts, from the general information to investment standard calculation and how to like calculate the penalties if we fail to meet the 90% investment standard. And there's also instruction on how to file this form to clarify every terminology that appears in the form. And there's a guidance on how to actually file and complete this form line by line. Next slide, please. In the third part is the tax benefit on existing capital gains. To be able to invest in this fund, the investors are required to put their capital gains from other investments like the profit from the mutual fund, private equity fund, real estate, or any kind of investment products. The investors need to pay taxes on their initial capital gains from those investment tools. However, if they invest those money in our fund, they will enjoy some tax benefit, depends on the time period they keep their money in our fund. So if the money is held for less than 5 years, the deferred tax payment on existing capital gains until the date that the fund investment is sold or exchanged can be enjoyed. This just basically means the investors can have the time value of money. If the money is held for 5 to 7 years, the above benefit are still enjoyed, and there is also a 10% of tax exclusion on existing capital gains. If the investment is held for 7 to 10 years, deferred tax payment on existing capital gains still exists. And then there's also a 15% of tax exclusion on the existing capital gains. If it's held for more than 10 years, the benefit of the 7 to 10 years investment are still enjoyed. Plus, the investors can also pay no capital gain tax on the appreciation of the fund investment. Next slide, please. The last part is what is the period in effect for the tax benefit? This should be one of the most concerned questions by the investors who are interested in our fund. The investors can defer their tax payment on prior investment gains if those gains are then invested in our opportunity fund within 180 days after sale. And the taxes are then deferred to either the day the fund investment is sold or exchanged, or December the 31st, 2026, whichever comes first. All right, here's the part of IRS, and then my teammate Aman will talk more about financial product part.
Thank you very much. So like Professor Zoro mentioned earlier, we serve as advisors, and the core idea is we're supposed to find a way to make this deal as profitable as to the sponsor, while also raising money from external investors. And as Stephen will get to after me in more detail, private equity funds. So the question at hand is to find a way to make the deal as profitable for private equity investors without compromising anything that we think is uncompromisable. We funneled it down to 3 things that we thought were the best things to target to make this deal go through. And the first was to offer an equity cushion. So we would have tranches where some equity investors have a seniority to others in terms of protection on cash flows. So some investors will be investing in a safer project than other investors, therefore opening us to a broader range of potential investors. The second is to shorten the investment horizon. You won't find too many PE firms who are willing to go 15 years, but you will find a lot more willing to go for 5. And the third is enhanced return. So when we can't reduce the risk, we want to increase the return. If you go to thank you. And so the proposed solution is a combination of using leverage and using seniority. Because of the nature of this project, falling rates doesn't naturally boost return. Meanwhile, other assets are all being boosted by lower rates. And so since all assets compete, we thought it's a good idea to introduce an interest rate component through leverage by taking a mortgage. And secondly, we broke the investors up into 2 tranches, limited partners and general partners. The limited partners take less risk in duration and in terms of on cash flows, and in turn they get a lower reward. The general partner takes more risk and gets a greater reward. So the scheme has certain rules, which is how we determine how the cash flows flow through the mortgage from our cash flows. I don't know if we're going to get into the exact business that we're investing into, but it goes through them into the mortgage and into the different tranches of equity investors. And the rules at which how it flows through the different investors is listed here. Primarily, the limited partner has priority on all cash flows up to what's required to meet its return and time horizons. The rest goes to the general partners, and if there's a shortfall to limited partners, the deficit is made up for by carrying forward that deficit to the remaining months to the remaining in the investment horizon to the best possible. Sometimes it won't be able to make up that shortfall if it's close enough to the deadline. Either the project, that time horizon will have to be extended, or the returns will have to be taken on with more leverage. And so if you go to the next slide, sorry, Master. And so this is the input model for the model that we used. It helps explain the rules in a much better way. The boxes which are in white is what our client will be using to input his characteristics for how he plans to run the project and the different stress tests and different situations. And so by moderating these certain criteria, he's going to be able to very easily and very quickly forecast the outputs for what the situation will look like, who will get paid off when, what risks are different people taking, where are the weaknesses, how does he want to be exposed in different ways. And without getting into each thing individually, the main inputs are the size, the leverage, the investor breakup, the rates, and most importantly, the targets. So by adjusting these different criteria, you can structure the project very quickly, very, very efficiently. So just on this one sheet, the entire model churns out like a machine. And so let's get into that model now in the next slide.
Hey, Aman,
Yes.
let me ask you a quick question. So when you say the client, so basically this is the type of presentation you will need to do for each investor, right? To entice them or not.
Sure. So each investor would use this, but the person who would gain the most from it is the person who is going to structure the deal. So a limited partner might want to look at when he's going to get paid off, and he'd use the same model to know when he's going to get paid off. But the most complicated thing is to plan it. So you want to know within this boundary of interest rates, within this boundary of time horizon, you want to be able the stress. You want to make sure how much boundary is there, how much room for error do you have, and you want to make sure that all the investors get paid off and get paid a good return. And so that's not possible with all interest rates or all time horizons. And so the person designing the deal will need a model like this to very quickly in one sheet just enter the stuff it needs to enter and see how it's going to play off, and then change a number and see what effect that has. And so he's very quickly able to design a deal that's going to be the best for all investors. Yes, thank you. So the start of the second column on the left is the one in white, comes from a different sheet. This is the pro forma revenue figures that we won't get into the business model in this presentation, but this is how we expect cash to come in. These are all fake numbers, but basically we hold some element to the truth. So we estimate that we're going to turn a loss for the first couple of years when it's the heavy investment. Cash flows have taken a while before we actually see any cash come to the company, and it will ramp up slowly and then exponentially towards a certain point where it flattens out. Then there are mortgage costs, and that's what this is also calculated from a different sheet. It's not very relevant. We just put it in here, and then we want to look at how much the cash. So each tranche has an entitlement. How much they put up, what proportion of the cash flow are they entitled to based on the proportion of capital that they put up with at the start of the project. But since this project has a difference in seniorities, the senior most tranche, the limited partners, have an entitlement, so that in their fixed period of investment they receive a certain return. And so this snapshot here is very useful to show how cash flow flows through the limited partners from the general partner. So the limited partner receives what he's entitled to, and the general partner sends his entitlement to the limited partner in the earlier months. So you can see here the green columns are the bottom line, so to speak, and the limited partners, you can see that their returns are generally getting higher and higher up until they reach the cap. That cap is what's required for them to reach their return in this specific time horizon, while the general investors receive nothing. And when we go to the next slide, you'll see that eventually in month, it's roughly month 60, or roughly month 50 or something like that, the cash flows have grown to an extent where they're able to pay off the limited partners and also start flowing to general partners. And once the limited partners get paid off fully, all the cash flow goes to the general partners. So what that does is it protects limited partners from contraction and expansionary risk, and exposes the general partners to expansionary risk. And the general partners compensate for that by having access to all cash flows for a longer period of time and a higher net return. And all of this will be seen it can be partially determined in the input screen you saw earlier and in the output screen, which is more complicated. We won't get into that. But through this, you can tell on a month-by-month basis how the cash is going to flow through the system based only on these inputs, that one sheet you saw in the earlier 2 slides ago. We go to the next slide, which has to do with the model output. We didn't get into the output here because it comes across fairly difficult to represent on the slide. But basically the takeaways that somebody who uses the model should be able to get is to see what the mortgage costs are going to be and what the magnifier for leverage is. So one of the arguments that we as the MFE team have made is that this project should take on leverage to make use of low interest rates. And so the effectiveness of that proposal has to be able to be measured very objectively, and this model does that. We also want limited partners, like Professor Zoro just asked me earlier. We want him to be able to see when he's going to get paid off and what his return is going to be, and what is the stress of what the fluctuation is going to look like. We want him to be able to enter different exit time horizons to see what suits him best. If we have multiple investors who have different horizons each, we want each of them to be able to fit in together. And the general partner's risk forbearance. So generally, the general partner is the equity cushion here. So we want to make sure that our client is comfortable with the amount of risk he's willing to take from the limited partners, and also take the reward. But the risk reward trade-off is up to him to decide. And so this model will be able to do that very intuitively. And of course, like you saw earlier, it offers you on a month-by-month level cash flow predictiveness, and it gives you a schedule for you to base, when you want to, when you have to have your cash ready to invest and so on. And finally, it's the stress test to be able to make sure that what levels of fluctuations will your investment be able to handle before you turn losses. So you want to be able to expect losses based on certain parameters. And so you budget for that, and that ties into how much risk you would demand. Sorry, how much return you would demand to consummate with that risk. Thank you. I'll pass on.
Thanks. So after coming up with the whole plan, we need investors to invest on this project. Therefore, we need to find the potential private equities that is suitable for our project. To do so, we mainly do 2 things. The first one is collecting the private equities data directly from the database called Excel. So basically, we got more than 450 equities data in this database. And as we can see, the locations of these equities almost cover all the big cities in the entire United States. Among these equities, we got 45 candidates that mainly focus on the real estate or manufacturing. Since some equity mentioned their requirements for the target company in their introduction, while some didn't. So I broadened their requirement like this if the company mentioned it.
Stephen?
Yes.
What technical tools did you use to get there?
Oh yeah, so I use Python to help me to collect this data from the website called Excel. And but given the fact that the data in Excel is not complete, like some private equities might not be in the database. So to find more private equities, the second thing we did is to collect the private equity conference list, as John suggested last time. So the conference we collected is going to be held in 2020. And the location is mainly focused on New York, Boston, Washington, DC, etc. The data is collected from the database called Times, which is a website that provides information of events in the United States. And the keywords we use to search in this website is private equity conference. So there are 118 conferences to be held from May to December in the entire United States. And as in this chart, many conferences are going to be held in June, September, and October. And if we focus on the cities that near us, we can know that New York has the most conference, and the conferences are mainly held in June and September. Because of the ongoing pandemic, most of the events have been postponed, but the data is still useful since we can find this conference website and follow it to know when they are going to be held again. So these are the basic information about the data we found in order to find investors. Hopefully we can find some suitable investors by contacting this equity or by joining this conference. And that's pretty much it.
Good. So I guess in conclusion, I'd like to maybe get you the opportunity to, well, first of all, we should say that the program is obviously this is not complete, because now we still need to have some discussion with John in terms of the type of investors that we're looking for, what his return is expected. We need to market. So, and this is what Remus was talking at the beginning of the presentation, that this should be an ongoing program, which will certainly go through the fall. But I guess I wanted to get some feedback from you, I guess especially from Kai, since he was the one that was there from the beginning. And you know, like any project, people come in, come out, and then some people stay based on the interest. But maybe give us some feedback, Kai, in terms of what you've learned through this process.
Sure. I think through doing this project, I have learned I have gotten a feel of how this investment works, and this is kind of like unique because it's tax-driven investment.
Stephen, you could take us out of the presentation.
What is it?
You could take us out of the presentation. Stop sharing. Okay.
Yeah, I think it has been enhanced, like a lot of abilities, such as data scraping and looking for like investors, and I have learned how this thing like is going to work. Yeah, I think this is very helpful.
Jonathan, you want to, because you're also graduating this year?
Yeah, so like when we, because I was responsible for the IRS documents and IRS tax form, I think like looking through those tax forms and those laws from the government, I think it's more kind of like what I have learned in the courses to practice. So I can understand the terminology that it's talking about, and I can help to form the financial models that we have learned in like fixed income or other courses. So this is kind of a practical experience for me to put what I've learned into practice.
And I want to bring out the fact that two of you on, and I mean, Z1 is she didn't present, but she's also part of the program, and she helped you along the way. So she'll be coming back in the fall for this program. But we should more know that Remus and Aman are actually not in the program. They are undergraduate, and hopefully they'll. I believe that Remus is definitely going to join in 2021. And John and I often had a conversation that these type of projects need to be, Lehigh wants to, we want to create problem solvers, leaders, right? So while it's always nice to go to class, get your curriculum, and then apply in your projects, sometimes it doesn't work that way, right? Sometimes you don't, you weren't taught half of these things, so you need to adapt. So Remus, why don't you give us a feel on your end as to what was that like? Because you're not in the program, and yet you had to come up to speed with what these guys knew very quickly, and yet, right, be part of the team.
So I've been involved in a couple projects with the MFE, and I feel like this is definitely one of the most challenging one, because a lot of the things that we're doing were, supposed to be for someone else who's already been doing a lot of IPO. Since this is a text-driven investment fund, we're really just looking what kind of informations we can get, and then we go to the SEC website, the IRS website, look at the staff statement, and kind of just gather informations and piecing everything together. And I think what Stephen was doing about data scraping, finding and trying to market our investment fund, it's definitely something challenging, and not like we don't learn that in school, but it is a really good practice to just kind of gather the informations and use the internet and see what you can piece out of.
Aman, what do you think?
Yeah, I thought it was a phenomenal opportunity. Like Ramos said, we worked in a couple of projects with the MFE team, and I'm extremely jealous. Like you mentioned earlier about how class is all well and good, but at Lehigh they want you to have all this stuff that you're missing out as undergrads. I'm really grateful to you and to Lehigh for giving me the opportunity to join on a program like that.
I just want to point out that Aman, yeah, we may have some technical issue with Aman, but he's actually in India right now, so that could explain. John, do you want to give us some parting, concluding comments here? So, can't hear you.
Sorry about that. I was on mute.
That's it.
I have questions, but several comments, and I'll reserve my appreciation for the end, because I think you guys just did a great job. So as I recall, Kabuki and Jonathan, this is it for you guys, right?
Yeah.
Okay, so this is pretty much going to be the last time. So I thought you guys did a wonderful job of helping us all kind of define the project, because both of you have been involved for the last 2 semesters with this. So I think if you recognize from our first lunch together at Lehigh with Professor Zorro till now, projects got definition, actually have a really good pathway forward. I really enjoyed the back and forth, and I think your insights were very valuable. So in that you were there from the beginning, I'd like you each to comment. So if we had to go to the AEDC board, this week, like say next Friday, because this is the end of the week, but let's say next Friday, what should we recommend to them? In other words, there's a lot of questions still to be answered, but here's what I heard you guys saying, and then and then we would say that and certainly recommend a path of action for them going forward. Sorry about that. That's there's a nice little road behind my house, and you can't see it, but you just heard the truck. So what I'd like to do is kind of have this conversation and treat the other members who are going to take the project forward kind of like the AEDC board, because they're going to get engaged with certainly that same board, me, for the next phase of the project. So I'd really kind of like to hear, with everything that you two researched and kind of guided, because certainly everybody else has contributed significantly to this, but from the very beginning, we had a few basic questions. So we were asking, and I think you've answered most of them, is this a legitimate investment based on the Tax Act that was passed? I believe I'd like you both to comment on that, but it sounds like it is. Then our next major question was, what are the SEC issues? I think you've covered that adequately. I would like to hear kind of like, okay, so based on those 2 things, again, what are your recommendations moving forward? Because there's a lot of pathways forward. And then when we looked at, well, okay, who are the potential investors from not only the land acquisition and building perspective, but also from finding corporations that we could move in to the manufacturing spaces that we're about to build. So I'd kind of like to hear, you know, again, it's not cast in concrete, but what are your feels about all the things that we started at and where we are today, and kind of specifically saying, well, this is kind of where we look forward. I don't think any of you know this, but I believe shared with Professor Zorro and myself the pro forma for what the land acquisition and building, shell buildings look like. So that'll certainly get incorporated into the next phase of the project. So I just wanted you to know, I told you that they were working on it. So like you guys have been working, they've been doing their fair share. So then after you guys make your comments, I want to throw it open to the other members who are going forward to see what questions you have, and then I have a bunch of comments. So shoot.
Thank you, John. It's been great working with you. It's been great working with you. Well, I think in SEC part, like because there are many exemptions, so like we may want to decide like which exemptions we want to use in our case. I think it's very important to do the compliance stuff. And for looking for investors, I think we may want to have make sure our business strategy will be will be delivered to the investors, because that's something they really care how we're gonna make profit for them. Yeah, that's my thought.
Yes, just want to thank you, John, for like providing this valuable opportunity for us to participate in this kind of a practical project, and really appreciate it. So for the IRS part, I think we have now collected all of the supporting materials that we have. So we have enough documents that from the government or IRS department. And the thing we need to do is to put together and make it look more professional. Maybe I would suggest you to maybe go find some professionals in tax or in tax law to talk with this, and then just put up a complete professional tax document that can publish to the investors and any potential investment that may be interested in. And apart from this tax part, for investors, I think the private equity and venture capital are two main sources that we can find investors, and not only from themselves, but also they have their limited partners that they put money in. I think they will also be interested in how to get the tax benefit by putting their capital gains in our opportunity fund. And since some of the investors may be invested in the industry of the manufacturing industry or real estate industry, they may also interested in put their initial principles into our fund, because we are in the similar industries. So I think these are the two main aspects that I want to add.
I'm just making a note. Cool. You know, I noticed in the presentation, it looks like if we would do the, I think it was the one section, and it was the 401 exemption, which capped it out at 5 million. I guess it's 5 million per project, correct? I don't remember. I think that may have been you, Aman, but I'm not sure that you were doing the presentation at that point. But I think that we probably, and just by listening to the presentation, it sounds like we're probably going to either have to register the fund or partner with a registered fund. And the reason I say that is because I'm not sure that $5 million for the project is going to get it. Now, I do know that you were talking about leverage, and we can talk about leverage in a second, but I mean, I'm presuming you're talking about leveraging with debt. but it sounds like we're probably leaning towards looking at some kind of a if and I would actually favor, and just based on what you guys presented and having not analyzed it and not thought too much about it, I probably would favor a fund that we create that we can have an unlimited number of qualified investors. So I'm not worried about including non-qualified investors. I'm more interested in doing qualified investors in that unlimited category. So I think that probably makes the most sense, unless one of you says, hey, you know, it's not that simple. But that's kind of where I would lean to at this point. Again, Kabuki and Jonathan, what are your thoughts, and any of the rest of you, what are your thoughts on approaching it from that angle? Because I think we're going to have to start, as you guys talked about, narrowing down our choices. And I don't want to give the board too many choices because they're very not sophisticated in any of this. So.
Yeah, sure. Because we want to only include a credit investor, right? So I would recommend to use 506C, Rule 506C, because that's the exemptions that allow us to, you know, have credit investors, and it's a good exemptions for us. And because of the registration with SEC is very costly and time consuming, so we might want to use exemptions, a Rule 506C. Yeah.
Good. Is there a cap on the amount of money we can raise under that, or is there no cap?
I think there's a capital limitation, but I can definitely look. You know, I will look into that.
Okay. That's kind of when you were going through it. It was 506C, very intriguing to me. I do like, in fact, it's interesting. You know, great minds sometimes think alike. Finding a good tax law firm that can develop an opinion on how the tax laws would be applied to our investment, I think, is going to be key in going out to the public, so that when somebody reads the opinion of that tax law document, that they're saying, oh, this is well researched. The last thing you want to do in any of this is look like you don't know what you're talking about, which is actually one of the reasons why I was curious on the 506C. If there was a total capital limitation, and by the way, I'm not sure there's probably a capital limitation per investment, but I'm more curious about the total fund accumulation, just so that we can kind of get our mind around how much money we can raise to do the projects that we're doing. Anybody else have any comments or observations as it relates to that? Let me speak to your leverage, because I know, and I'm trying to remember. So Ramos and Mon, you guys are both going in, is that right?
Yes.
Can you guys hear me?
That's right. Yeah. So we want to mute.
Oh, you know what? Oh, yeah. So yeah. Which ones of you are continuing with the project past the summer? Stephen, are you continuing?
I maybe have a capstone course in the next semester about other things, so I'm not sure about it.
But now, Stephen, that will be part of your capstone course as well.
Okay,
So
yeah.
you're continuing, and Z1 will be part of it.
Oh, okay.
Well. Yeah.
And
So I just say something so I can hear your voice. I haven't.
I can't hear you.
Hi. Okay, so you're also doing the capstone course?
right.
All right. And then how about Aman and Ramos?
I won't be in the program for MFE until I graduate from undergrad. I'll be a senior next year, but
Okay.
I'll still be in the project. I'll follow through.
Cool.
Yeah.
And how about
I
you,
graduated
Aman?
last week. Yeah, I graduated last week, so I'm on to new things outside Lehigh now. And I'm like Professor mentioned, I'm back in India now. So,
Okay. So do you know what you're going to do next?
TBD. It's the big TBD.
Okay. Well, whatever you do next, good luck to you. And I
Thank you very
felt
much.
like you did a very, very fine job. So Zuan, Ramos, Stephen, I look forward to working with you. Aman, if there's anything I can do to help you with your TBD, just don't ever hesitate to ask. Occasionally, an old guy like me that writes a recommendation is sometimes appreciated. So if I can do any of that for
I
you,
appreciate that
let me
very
know.
much. Thank you.
The thought. Oh, you're welcome. And by the way, that goes for for Kabuki as well. As you guys progress, if you need somebody to write something on your behalf, I'm more than happy to do that for you both. I was going to save that to the end, but just sometimes I forget things. So you guys.
I'm sorry.
Thinking Zorro a concept, but it's like what I'm sure he's sitting there going, "What the hell is he talking about?" So it's always a funny kind of experience. But I really think that you guys have helped define it. You guys brought up leverage, and I'm presuming you're talking about debt leverage. One of the things I wanted to add for you guys that are graduating, but for the 3 that are staying with the project, see, debt leverage is very interesting. So particularly in this case. So banks in the United States, in order to get licensed as a bank, chartered as a bank, you are required to make